If you have an HSA right now and you're using it like a debit card for copays, you're leaving tens of thousands of dollars on the table by retirement. And the IRS actually built 3 separate tax breaks into this account that most people never touch. The simple version is this: an HSA is a tax-advantaged account for medical expenses, and you can only fund one if you're enrolled in a high-deductible health plan. But here's where it gets interesting. Treating it as a debit card for this year's copays throws away almost everything that makes it powerful. The real machine has 3 moving parts, and I'll walk you through each one. Part 1 is the deposit. For 2026, the IRS set the HSA limit at $4,400 for self-only coverage and $8,950 for family coverage. And that limit counts both your money and any your employer adds. The magic is that every dollar you put in is deducted from your taxable income. So, at a 22% bracket, contributing an extra $3,400 saves you roughly $748 in federal tax that year, a modeled figure. That's just the first of 3 breaks. Part 2 is the growth, and this is where most people leave money on the table. HSA funds don't have to sit in cash. You can invest them in mutual funds or ETFs, and every dollar of growth is completely untaxed. Modeling shows one $8,750 family contribution invested at 7% grows to about $66,787 over 30 years, versus only around $11,812 if you leave it in cash at 1%. That's a $55,000 difference from a single decision. Part 3 is the withdrawal. When you take money out for qualified medical expenses, it comes out completely tax-free. No income tax, no capital gains tax. Compare that to a taxable account, where 30 years of gains could face a 15% capital gains bite, easily tens of thousands of dollars on a large balance, all modeled. That's the 3rd free pass, and stacked together, that's the triple tax break. Here's the gate everyone forgets. You can only fund an HSA if you're on a qualifying high-deductible health plan. For 2026, that means a minimum deductible of $1,700 self-only or $3,400 family, with out-of-pocket maximums capped at $8,500 and $17,000. If your plan is almost an HDHP but misses one of those numbers, your contribution limit is effectively 0. You're locked out of all 3 tax breaks. New for 2026, the rules just got wider. Under the One Big Beautiful Bill Act, Bronze and Catastrophic ACA Marketplace plans automatically qualify as HSA-eligible HDHPs starting January 1, 2026. That applies to individual coverage bought through healthcare.gov or your state exchange, not small business shop plans. And it makes millions more Americans eligible to open and fund an HSA for the first time. There's one more lever, and it kicks in at 55. Once you're 55 or older by year end, you can add an extra $1,000 a year as a catch-up contribution on top of the standard limit. Do that for the 10 years from 55 to 60 FIA. And you've stashed an extra $10,000, saving roughly $2,200 in federal tax at a 22% rate, modeled. Skip it, and that's money and growth simply left behind. Now here's the catch the brochure never spells out. Because people think an HSA is just a spending account, they contribute only what they expect to spend this year, say $1,000, and empty it every December. Modeling shows that if you'd instead maxed $4,400 self-only and invested the difference, the extra $2,400 could grow to over $18,000 by 65 on a 7% return. The account isn't broken. The way people use it is. Before I get to what this means for you at each life stage, which is the most counterintuitive piece of this, here's how big the gap actually gets. Modeling a family maxing $8,950 a year at 7%, the HSA grows to roughly $826,000 over 30 years, all potentially tax-free for medical costs. A cash and spend user ends with essentially nothing invested and pays around $33,000 more in federal tax along the way. If this is useful, subscribe. The next breakdown is already coming. Here's the counterintuitive part for younger people. The smartest move is often to pay this year's small medical bills out of your regular checking account and leave the HSA fully invested and untouched. You're deliberately turning it into a stealth retirement account for healthcare, where decades of growth come out tax-free. The longer you leave it alone, the more that triple tax break works in your favor. No matter your age, the two-step is the same. First, confirm your health plan is actually labeled HSA eligible and meets the 2026 deductible and out-of-pocket rules. Otherwise, none of this applies to you. Then log into your benefits portal, subtract any employer contribution from the limit, and set your payroll amount so the total lands within a few dollars of $4,400 self-only or $8,750 family without going over. Next, I'm covering the high-deductible health plan trap, how a low premium can quietly cost a family thousands in the year someone actually gets sick, and how to tell before you enroll. If you want to catch that one, subscribe so you don't miss it. I'll keep reading the fine print so you don't have to.